Dow's down 306. Mike Santoli taking a look at how trade war fears between the U.S. and China continue to push both markets lower, with the dollar hitting the highest level against the Chinese yuan since December of last year.
Yes, Sarah, pushing both markets lower, but of course the Chinese market going a lot lower than the U.S. market, at least for right now. In fact, some could interpret the U.S. market weakness as a little bit of a catch-down move to what's been happening in the emerging markets, specifically China. A lot of different ways to cut the Chinese equity market. Look at some of the ETFs that do track some of those various indexes there. The MCHI is basically the MSCI China index. That's going to be your, which line is that? That's the orange line right there. It's right in the middle. So yes, the two largest holdings are Tencent and Alibaba at 29%. That's why it's mitigated some of the weakness in the FXI, which is really much more a tracker of the mainland Chinese economy. Yes, Tencent's in there, but a Chinese construction bank. It's the banks, it's the insurance companies, oil companies. That's been where you've really seen the pain. And I did add the KWEB, which is the Crane Shares Chinese Internet Stock Index, just as a comparison, because that's what's holding up the broader Chinese market. That green line right there is sort of the Chinese version of FANG. It's performing okay still, up 4% year to date, up 24% over 12 months. So everything outside, kind of like our market, everything outside the big growth stocks in tech are suffering, but over there suffering a whole lot more, at least right now.
And I guess the view there is they're more vulnerable in this trade
just
war
much more
fight.
dependent in general on global trade volumes. It's a much more export-geared economy than ours is. So, you know, at least right now on a relative basis, the market seems to be trying to sort of localize the pain where it's going to be felt the most.
Meanwhile, looking for leaders today, right? I mean, since Netflix is not with us today, nor is the Russell.
And that's why you see the overall market backing off more than 1%. So, you know, it's through this period of kind of range-bound trading, you haven't seen the real defensive stocks outperform. And so a lot of people taking heart in that, saying, well, look, if it was going to be a bear market, those stocks would be working. Today is one example of when you do have it.
What's your sense of when the market, I don't know if you call this a panic, a 1% move in the Dow with the amazing run-up it's had, but what's your sense in how the market takes the trade headlines day by day, sometimes reacting quite differently to them?
It does. There had been a little bit of a diminishing effect, but that's mostly because small caps and tech gave you a place to hide on a given day. I think the market really wants to resist the idea that this is a broad-based kind of game changer. S&P 500 earnings estimates are not going down very much. The fundamentals
they're going up in some cases.
Exactly. And now, you know, if that's kind of a head fake, that's your problem. The folks at BofA Merrill are saying, look, a lot of this stuff looks very toppy right now, but really the corporate fundamentals are hanging in there. The U.S. credit markets are fine. It's not as if we're seeing a lot of kind of ancillary panic out there in the capital markets.
Although a ton of issuance on corporate debt.
Yes.
Big week for IPOs.
We're swallowing it so far. So you have to. The question is, you know, is the market just growing a little bit tired at the wrong time when a lot of these headlines are a bit unfriendly? And I do think that's why people are keeping the market traders anyway on a bit of a short leash, because the S&P has not proven itself. It didn't get back to the March highs. It's lost June's upside already. And so that's why I do think it's still kind of this nervous, choppy environment.
Is there a line in the sand? I mean, David asked this earlier. Is there a point, a date, or maybe a marked escalation in the form of auto import tariffs where this does become an economic growth story?
You would think there is a threshold there, and the emerging markets, you know, kind of driven by the currency moves, are telling you that there's risk of that. I wonder if the bigger potential risk for investors' point of view is that this is it. We're just going to have this exchange of measures and threats, and it's not going to lead toward a process. It's not going to necessarily lead toward some kind of negotiating angle where we can sort of try to handicap how it's going to play out. If it's really just we're going to do this and then you're going to do that. And yeah, I mean, autos, those stocks are already getting hit hard. You look at the European auto stocks. So something out there would make it seem like it's broader, and the market's ability to try to quarantine it is going to fail.
New lows for the year on JP Morgan and on Caterpillar. Which do you think is more important?
I think JP Morgan is more important. I mean, I don't think you need the banks to kind of lead the way. I think that's kind of an old rule that's kind of become obsolete. But it's been very conspicuous that you have a lot going for them, and it's obviously a proxy for the yield curve and all the rest of the things that I think are leading people's worry list, whether they should or not.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.